Hi there, it's Michael Kramer of Mott Capital. Today is April 2nd, and it's around 6:15 New York time. So I just thought we'd start off with the central bank calendar. There's going to be a lot of speakers the balance of this week. Jay Powell is scheduled to talk tomorrow at 12:10 p.m. Eastern at Stanford. He'll be giving a speech on the economic outlook, and he'll also be doing Q&A. So that's obviously a discussion that you're probably going to want to pay attention to. And, he did just speak on Friday, so it'll be interesting to see if he has any other additional comments from what was spoken about just a few days ago. But there's also going to be a lot of economic data here in the U.S. starting tomorrow as well. You're going to get ADP at 8:15 a.m. Eastern. We're looking for 150,000 versus last month's reading of 140,000. Then at 10 a.m., we're going to be getting ISM services. We're looking for 52.8 versus last month's 52.6. Prices paid, we're looking for 58.4 versus 58.6. ISM services employment, we're looking for 49 versus 48. ISM services new orders, we're looking for 55.5 versus 56.1. So on the headline number, we're looking for something a little bit stronger, but most of these numbers seem fairly weaker with just a minor improvement in employment. Reminder that a number below 50 suggests contraction. So this would suggest a pretty weak employment picture if that were to be correct. And then, of course, on Friday, we're going to be getting the change in non-farm payrolls. We're looking for 214,000. Less than last month's reading of 275,000. Change in private payrolls, 170,000 versus 223,000. The unemployment rate's expected to dip to 3.8% from 3.9%. Average hourly earnings expected to increase to 0.3% month over month from 0.1%. Year over year, we're looking for a 4.1% number, down from 4.3%. Average weekly hours, we're looking for 34.3% versus last month's reading of 34.3%. So basically, when we look at where we are currently with rates, interest rates certainly are on the cusp here of potentially advancing and finally breaking out above this 435 level. You're going to need positive data to kind of support this movement, though. So if the data should come in weaker, then there's a good chance you're going to see rates give back a lot of these gains that you've seen in the last two sessions. So you're going to want to pay attention to this data, and more importantly, this data really needs to be supportive of rates breaking out. And it seems like at first blush, at least, the next major level of resistance for the 10-year would probably be somewhere around 450. I mean, there's certainly very strong momentum here in the 10-year, and we could certainly make an argument that there's a nice uptrend and with a breakout for the 10-year. And so certainly from a technical perspective, one would think that rates would probably be moving higher on the back of the curve. When we look at the front of the curve, there's a pretty nice looking picture as well. Again, positive momentum, plenty of to suggest that we could move higher. There's also a nice uptrend in the 2-year as well. We could be forming an ascending triangle. So this would suggest if we get above this 475 area, which has been tough resistance as well, you could see the 2-year start heading back towards 5%. And so clearly for this to happen, you're going to need some sort of really strong jobs number, perhaps really good wage growth, something to support this idea that the Fed is going to not be cutting rates even 3 times this year, because to get a number, a 2-year around 5%, you're going to need a Fed's fund rate probably for by the end of 2024, somewhere around 5%. And currently we don't certainly have that projection. So the market right now is positioned to see a really big move in rates if we get data that's really supportive. And obviously, if we get a big move in rates, you're probably going to get a dollar that's going to continue to surge. We've certainly seen the dollar testing the February highs. We can certainly see that there's a nice uptrend in the dollar. We've broken a downtrend. It almost looks like the same pattern and setup we have in the 10-year and in interest rates in general. So it just seems very obvious at this point that stronger data is going to lead to a higher dollar index. That likely leads to a lower euro. Right now, we have this potential reversal diamond pattern in place. There is clearly a downtrend in the euro. We have certainly a downward shifting momentum indicator on the euro. And so what this kind of implies here is that right now, again, assuming that US data is going to be strong, you're likely to see the euro kind of retrace back to this 106.90 area and potentially set up a potential move back to this 105 region. It's the same sort of thing really for the pound. The pound has really weakened rather materially. This is sort of the lower end of the range right now. You can clearly see that momentum is negative. There's clearly a downtrend that's formed. So at this point, we're looking for support around 125 with a break of support at 125. We'll get rid of this. With a break of support at 125, potentially setting up a decline to around 124. And really a potential decline back to this 122.80 area. When we look at the US dollar Swiss franc, a very similar sort of setup. Actually, the Swiss franc has returned to the levels we saw in October and early November. So the Swiss franc has been really weakening versus the dollar. We can also see that the Swiss franc has also put in what looks like there's a potential downtrend that's being broken. Clearly, momentum is to the upside, although we are getting a little bit over an overbought reading on the RSI. The Bollinger Band suggests there's still plenty of room to go. So it could be that we're going to see the Swiss franc get back to around 91 cents and then potentially push higher still. So we're going to want to watch what happens at resistance at this 91 area, which basically comes at the peak from November 2nd. Then when we swing over to the yen, we can see this is a very delicate area for the yen. Markets are very hesitant to really push this thing any higher. They're going to need a reason to really push this higher. You're going to need a fundamental reason to push this higher, right? Because the ministers and officials in Japan have been basically saying that it looks speculative. It doesn't look like it's trading on fundamentals. So if you look at the spread between the U.S. and Japanese 10-year, you could say that maybe that is the case, that it has been a little bit more speculative, but you can also see that that spread is starting to widen again, which could give you a reason to say, hey, you know what? Fundamentally, it's beginning to make sense for the yen to start moving up again because those spreads between the U.S. and Japanese 10 years are beginning to widen. And if this should widen further, you can really start making a case that, hey, fundamentally, it makes sense for the yen to weaken further and to push up beyond this 151.5 area and probably beyond 152. When we swing over to U.S. equity markets, the Dow was beat up pretty well today, down about 1%. Most of these losses, though, came from UNH, United Health, which is the largest component in the Dow. It did sink by about 6.4%. It also kind of broke a little bit of an uptrend and support. So the Dow certainly came under some pressure today because of that. The Dow, you can see, basically closed right on the 20-day moving average, just slightly above it. So this is going to be an area right in here we're going to want to watch because we can see the Dow has gotten below the 20-day moving average for a couple of times in the past. So you're not really, in other words, at this point, you really don't want to see the Dow deviate too much from the 20-day moving average. If we start trading down in this 38,465 area, you can probably start thinking that something has changed in the Dow. It also looks like there's potentially a double top pattern forming here with this being the neckline. We gap below this level of support, which really goes back to a high on February 23rd. So again, we're going to want to watch this area right in here around 39,000 with a break of that, potentially setting up something a little bit steeper. And UNH is obviously going to be one of the big drivers here. If it should continue to weaken, it's going to be hard for the Dow to really mount a move higher. RSI just clearly trending lower now for several months, which is really just a bearish divergence, a sign of momentum loss. And you can kind of tell momentum has been lost because the Dow has basically been sort of grinding, higher, but at a much slower rate than what it was doing earlier on. And then also when we just kind of take this trend line here, here's our trend line, very close to breaking what would be an uptrend in the Dow as well. So if you gap below this level and you take out this 39,000 region, I think you're talking about opening up the doorway to something much lower, probably 38,450 or so. Likewise, we did have a gap lower today And so there's always an opportunity and the possibility that tomorrow morning we gap higher and we return to fill this gap here at 39,551. When we move over to the NASDAQ, again, same thing, gap lower. That always means that we have the potential to go back and refill this gap at 18,292. But overall, when we look at the NASDAQ, again, just like the Dow, we have this downward momentum kind of forming in the index. If rates are going to start going higher, if the dollar is going to start strengthening again, if financial conditions are going to begin to tighten, then that's going to probably mean that stocks trade lower. That's just how it's really worked now for some time. Basically, at this point, the NASDAQ's still pretty much in the same spot, give or take, where it was on February 12th. So there's just been a lot of sideways consolidation in the NASDAQ over the last couple of months. Certainly, we still have this rising megaphone pattern, which, again, we're just watching to see how it develops. If the NASDAQ starts trading down to this 17,850 area, this continues to be really the key level of support. This is from NVIDIA's results. We haven't gone below it since February 22nd, more than really a day. And so this is going to be a key level to watch if we should get down there and test it. You can see that we're trading below the 20-day moving average. We really haven't traded below the 20-day moving average for more than a day or two. So if you don't get above this 20-day moving average, let's say tomorrow or by the latest by Thursday, and you actually keep moving lower, you really have to question again whether or not something has materially changed. And then you have to really be watching very carefully around the 17,850 area, because if that breaks, you're talking about filling the gap from back here on February 21st. But more importantly, you're also talking about breaking this uptrend of the megaphone pattern, which could be suggestive of this consolidation phase being over and the trend reversing. Finally, when we look at the S&P 500, notably today, we gapped lower. We gapped below this trend line that's really been in place since November 1st, which is sort of important. And the other piece here is that we also closed below the 10-day exponential moving average, which we know can at times be a level of support. You can see certainly in the past that has been the case. Here it served as support. Here it served as support. Here it served as support and support. In all these different regions, you can see that it served as support. So breaking below it today by gapping below it certainly doesn't mean anything after one day. But all of a sudden, if you get 1, 2, 3, 4 days down below the 10-day, that could also be a sign of something changing as well in the S&P. So certainly there's warning signs. There's reason to think that there could be a change in trend blowing in the wind. But at this point, we still need further confirmation. For that really to happen, I think you need to see rates move up, the dollar move up, financial conditions show signs of tightening. Maybe that means that the HYG ETF, a high yield ETF, starts trading lower. If that starts to happen, that's going to really be the cue that something is materially changing in the market. And that's going to be your indication that, the winds of change may actually be blowing. And again, for that to happen, you still need better than expected economic data. And that's really all we have. Looking forward to seeing you again next week. Take care. Bye.